Advanced Taxation. Table of Content. Introduction. Chapter 1. Introduction to Advanced Taxation. Chapter 2. Corporate Taxation Fundamentals. Chapter 3. International Taxation and Cross-Border Planning. Chapter 4. Transfer Pricing in Depth. Chapter 5. Mergers, Acquisitions, and Tax Structuring. Chapter 6. Indirect Taxes, VAT, GST, and Excise. Chapter 7. Tax Risk Management and Controversy. Chapter 8. Taxation of Emerging Sectors, Digital Economy, Crypto, ESG. Chapter 9. Tax Policy, Reform, and Macroeconomic Impacts. Chapter 10. Tax Technology and Automation. Chapter 11. Advanced Tax Planning Strategies. Chapter 12. Estate, Gift, and Wealth Tax Planning. Chapter 13. Taxation in Financial Instruments and Investment Planning. Chapter 14. Corporate Restructuring and Tax Optimization. Chapter 15. International Tax Compliance and Reporting. Chapter 16. Tax Controversy and Dispute Resolution. Chapter 17. Tax Policy and Economic Development. Chapter 18. Emerging Trends in Global Taxation. Chapter 19. Integrating Tax Strategy with Business Strategy. Conclusion. Introduction. Taxation is a cornerstone of modern economies, shaping corporate strategies, public policy, and individual financial decisions. In an era marked by globalization, digitalization, and rapid innovation, the field of taxation has evolved far beyond compliance and routine filing. Advanced tax knowledge is now essential for professionals who seek to navigate complex domestic and international landscapes, optimize financial outcomes, and uphold ethical and legal standards. This book, Advanced Taxation, provides a comprehensive exploration of sophisticated tax principles, strategies, and applications. It bridges theory with practice, offering insight into corporate taxation, international frameworks, emerging sectors such as the digital economy and cryptocurrencies, ESG-linked taxation, and advanced planning techniques. Each chapter builds upon the last, guiding readers from foundational concepts to complex strategic integration. With technology transforming how taxes are calculated, reported, and managed, the modern tax professional must harness AI, automation, analytics, and blockchain to enhance accuracy, efficiency, and compliance. At the same time, ethical responsibility, transparency, and professional judgment remain paramount in building trust with stakeholders and regulators alike. The purpose of this book is not merely to explain rules, but to equip tax professionals with the analytical tools, strategic thinking, and ethical perspective necessary to excel. Through practical examples, case studies, and forward-looking discussions, readers will gain a holistic understanding of taxation that integrates technical proficiency with business acumen. Whether you are an aspiring tax advisor, a seasoned professional, or a business leader seeking deeper insight into tax strategy, this book will serve as a valuable guide. By mastering the concepts herein, you will be prepared to navigate complexity, influence strategic decisions, and contribute to sustainable economic and organizational growth. Embark on this journey to understand advanced taxation, where knowledge meets strategy, ethics, and innovation, shaping the future of finance and business. Chapter 1. Introduction to Advanced Taxation. The Evolving Landscape of Taxation. Taxation is as old as organized society itself. From the tribute systems of Mesopotamia to modern digital services taxes, the fundamental premise has remained the same. Societies need revenue to function, and that revenue must be raised equitably and efficiently. Yet in today's globalized, hyper-connected economy, taxation is no longer simply a matter of collecting income tax and sales tax within national borders. We live in a world where capital, data, and labor flow across jurisdictions at the speed of light, creating both unprecedented opportunities for wealth creation and profound challenges for tax authorities. Advanced taxation is not merely about calculating liability under the Internal Revenue Code or your country's equivalent statute. It is about understanding the architecture of tax systems, navigating competing objectives, revenue collection, fairness, economic growth, and managing the friction between taxpayers and governments. This book is designed to equip you with the conceptual tools, analytical skills, and practical strategies needed to thrive in this complex domain. Why advanced taxation? Most professionals first encounter taxation through a relatively simple lens, learning how to prepare individual income tax returns, compute corporate tax liability, or record deferred tax assets on a balance sheet. These are important foundational skills, but they barely scratch the surface. Advanced taxation moves beyond compliance into strategy, risk management, and policy impact. It requires asking deeper questions. How do international tax treaties affect cross-border mergers? What is the tax implication of a decentralized, autonomous organization, DAO, issuing tokens? How can a business legally minimize tax exposure while respecting anti-avoidance rules? What are the macroeconomic effects of shifting from income taxation to consumption taxation? These questions involve multiple layers of law, economics, and ethics. They require integrating knowledge of statutory provisions, case law, administrative rulings, and, critically, the intent behind them. Advanced taxation is about interpreting not just the letter of the law, but its spirit, anticipating how authorities will view novel transactions, and designing structures that are both tax-efficient and defensible. The role of taxation in economic strategy. For businesses, taxation is not merely a cost of doing business, it is a factor in strategic decision-making. Multinational enterprises weigh effective tax rates when choosing where to locate headquarters, intellectual property, and manufacturing plants. Governments, aware of this, compete for mobile capital through incentives and tax holidays, creating what economists call tax competition. Understanding these dynamics is critical. For example, a pharmaceutical company may choose to house its patents in a jurisdiction with favorable intellectual property regimes, e.g., patent box regimes, to benefit from preferential tax rates on royalty income. A private equity fund may structure its investments through limited partnerships or special-purpose vehicles to ensure capital gains treatment rather than ordinary income treatment. Each of these decisions has ripple effects not only on the taxpayer, but on the revenue base of countries and the fairness of the overall tax system. Taxation as a balancing act. The complexity of taxation is partly a result of competing objectives. Revenue generation. Governments need revenue to fund infrastructure, defense, education, and healthcare. Equity. Tax systems are expected to be fair, distributing burdens according to ability to pay. Economic efficiency. Taxes should minimize distortions and avoid discouraging productive economic activity. Simplicity and administrability. Compliance and enforcement should be feasible without excessive cost. Competitiveness. In a global economy, jurisdictions must remain attractive to investment. Advanced taxation professionals must constantly navigate these trade-offs. For instance, highly progressive income taxes may satisfy equity concerns, but risk discouraging entrepreneurship or encouraging tax avoidance. Aggressive corporate incentives may attract investment, but erode the tax base. Emerging trends in taxation. No exploration of advanced taxation would be complete without acknowledging the rapid evolution of the field. Several megatrends are reshaping how we think about tax policy and practice. 1. Digital economy taxation. The rise of digital giants, many of which operate globally without significant physical presence, has challenged the traditional nexus rules of corporate taxation. The OECD's Base Erosion and Profit Shifting (BEPS) project and Pillar 1-2 initiatives represent historic efforts to update international tax rules, including a global minimum tax of 15% for large multinationals. 2. Environmental and carbon taxes. Taxation is increasingly being used as a tool to address climate change. Carbon pricing mechanisms, whether taxes, cap-and-trade systems, or hybrid approaches, seek to internalize the cost of greenhouse gas emissions and steer economies toward sustainability. 3. Wealth and inequality debates. The concentration of wealth has reignited calls for wealth taxes, higher estate taxes, and financial transaction taxes. Understanding these proposals requires grappling with questions of tax-based measurement, avoidance behavior, and potential capital flight. 4. Technology and tax administration. Machine learning, blockchain, and real-time reporting systems are transforming tax administration. Tax authorities now use data analytics to identify fraud, while taxpayers leverage technology to optimize compliance and planning. 5. Ethical and reputational considerations. In the age of social media, aggressive tax avoidance strategies can carry reputational risk. Stakeholders, including investors and consumers, expect corporate behavior to align with environmental, social, and governance (ESG) principles. The tax morale of both companies and individuals is increasingly under scrutiny. Case example: the double Irish with a Dutch sandwich. Consider the now infamous tax planning technique, colloquially known as the double Irish with a Dutch sandwich. Multinational tech companies use this structure to shift profits to low or zero tax jurisdictions by routing intellectual property royalties through a series of Irish and Dutch entities. While entirely legal at the time, public backlash and international pressure led Ireland to phase out the arrangement. This example highlights a core theme of advanced taxation: what is legal may not always be sustainable. Tax planning must account for legal compliance, reputational exposure, and the likelihood of law changes. Skills required for the advanced tax professional. Success in advanced taxation requires a blend of technical, analytical, and interpersonal skills. Legal analysis, ability to interpret complex statutes, treaties, and case law. Quantitative skills, competence in modeling after-tax cash flows and effective tax rates. Strategic thinking, understanding of how tax interacts with business objectives. Communication, capacity to explain complex tax concepts to non-specialists. Ethical judgment, awareness of the line between acceptable planning and abusive avoidance. This book will help you develop these competencies through theory, examples, and practical frameworks. The journey ahead. The chapters that follow will dive deep into corporate tax planning, international taxation, transfer pricing, mergers and acquisitions, indirect taxes, tax risk management, and more. Each chapter is designed to build on the previous one, equipping you with progressively more sophisticated tools. Advanced taxation is not static. It is a living, evolving discipline that responds to economic, political, and technological change. As you progress through this book, keep in mind that your role as a tax professional is not merely to minimize liability, but to create value responsibly, balancing the interests of clients, governments, and society at large. Key takeaway: advanced taxation is about strategy, judgment, and adaptability. Mastering it requires not only technical knowledge, but also an understanding of the broader context in which tax systems operate. This chapter has set the stage. Now we turn to the mechanics and applications that make taxation one of the most intellectually challenging and impactful fields in business and public policy. Chapter 2: Corporate Taxation Fundamentals. The central role of corporate taxation. Corporate taxation is the backbone of advanced tax practice. While individual income tax grabs headlines during election cycles, the corporate income tax drives significant planning, policy debates, and compliance work. For multinational enterprises, the corporate tax function is often a strategic hub that influences capital allocation, supply chain design, and shareholder returns. Corporate taxation is, at its core, a mechanism for taxing the profits of business entities. But the definition of profit is anything but straightforward. Tax law introduces concepts that differ from financial accounting, creating temporary and permanent differences that tax professionals must reconcile. Determining taxable income. At a high level, taxable income for a corporation is computed as gross income, allowable deductions equals taxable income. Yet each of these terms requires careful interpretation. Gross income. Gross income for tax purposes generally includes all income from whatever source derived: sales revenue, service fees, rents, royalties, dividends, and capital gains. However, certain items may be excluded under statute, e.g., municipal bond interest, or deferred, e.g., certain like-kind exchanges. Deductions. Corporations are allowed to deduct ordinary and necessary business expenses, including salaries, rent, interest, and depreciation. However, tax law imposes limitations on certain items, such as meals and entertainment, often partially non-deductible. Executive compensation. Deductibility may be capped beyond certain thresholds. Interest expense. Subject to earnings-based limitations under thin capitalization and anti-base erosion rules. Understanding these limitations is crucial, as they directly affect the effective tax rate and after-tax profitability. The tax versus book gap. A perennial challenge in corporate tax practice is the divergence between tax reporting and financial accounting, book income. For example, depreciation for tax purposes may be accelerated relative to book depreciation, creating deferred tax liabilities. Advanced practitioners must not only calculate these differences, but also anticipate how they will reverse in future years, impacting cash flows and financial statements. Corporate tax rates and structures. Different jurisdictions impose corporate taxes at varying rates, from single-digit regimes designed to attract investment to rates exceeding 30% in some countries. Some jurisdictions apply flat rates, while others have progressive or tiered structures. The global average statutory corporate tax rate has declined over the past 4 decades, reflecting heightened tax competition. Yet the effective tax rate, ETR, a corporation faces depends not only on statutory rates, but also on incentives, credits, and planning opportunities. Example: effective tax rate calculation. If a corporation reports $10 million in book income, but claims $2 million in accelerated depreciation deductions, its taxable income is $8 million. At a 25% statutory rate, the tax liability is $2 million, producing an ETR of 20% on book income, lower than the headline rate. Loss utilization and carry-forwards. Corporate tax systems often allow the use of net operating losses, NOLs, to offset future taxable income. Rules vary by jurisdiction regarding carry-forward periods. Some allow indefinite carry-forward, others limit to a fixed number of years. Carrybacks. Some systems permit carrying losses back to claim refunds for prior years. Change of ownership limitations. Restrictions may apply to prevent trafficking in loss corporations. Tax professionals must carefully model the value of these attributes, as they can significantly affect deal valuation and restructuring decisions. Corporate tax credits and incentives. Many jurisdictions offer targeted tax credits to encourage certain activities. R&D credits to incentivize innovation. Investment tax credits for capital expenditures in preferred sectors. Employment credits for hiring from disadvantaged groups. Understanding qualification criteria and documentation requirements is critical. Improper claims can result in disallowance, penalties, and reputational damage. Tax accounting methods. Corporations must adopt and consistently apply permissible methods of accounting for tax purposes: cash versus accrual, inventory costing methods, FIFO, LIFO, weighted average, and revenue recognition principles. Changes in accounting methods typically require regulatory approval and may trigger adjustments. Risk management and controversy. Corporate tax filings are subject to audit. Common areas of controversy include transfer pricing adjustments, deductibility of intercompany charges, classification of workers, employee versus contractor, substance over form challenges. Advanced tax professionals must maintain robust documentation and prepare for potential disputes with tax authorities, sometimes escalating to administrative appeals or litigation. Ethical considerations. Corporate tax planning occupies a gray area between compliance and avoidance. Professionals must balance their duty to shareholders to minimize tax with their obligation to comply with both the letter and the spirit of the law. Increasingly, boards of directors and audit committees demand transparency and alignment with ESG goals. Looking ahead. This chapter has outlined the mechanics of corporate income taxation, the starting point for more sophisticated planning techniques. The next chapters will explore international considerations, including transfer pricing, cross-border structuring, and the impact of global minimum tax initiatives. Key takeaway: mastery of corporate taxation fundamentals is the foundation of advanced tax strategy. Only with a clear understanding of how taxable income is computed, what deductions are permissible, and how effective tax rates are derived, can practitioners engage in meaningful planning and risk management. Chapter 3: International Taxation and Cross-Border Planning. The global dimension of taxation. As businesses expand internationally, taxation becomes exponentially more complex. Domestic rules must now interact with those of multiple jurisdictions, as well as with international treaties and supranational initiatives such as the OECD's BEPS framework. Cross-border taxation is no longer the exclusive concern of large multinationals. Startups, freelancers, and even digital content creators find themselves navigating foreign tax rules as soon as they have customers or suppliers abroad. International tax planning is not about exploiting loopholes. It is about understanding and reconciling competing tax claims by different jurisdictions. The goal is to avoid double taxation or double non-taxation, optimize effective tax rates, and remain compliant with anti-avoidance measures. Key principles of international taxation. Residence versus source. Most countries assert taxing rights based on either residence, taxing the worldwide income of resident companies or individuals. Source, taxing income that arises within their borders, regardless of the taxpayer's residence. A multinational enterprise, M&E, may thus be taxed by its home country on global income, residence-based, and simultaneously by host countries on locally sourced income, source-based. This creates potential for double taxation. Double taxation agreements, DTAs. Double taxation agreements, or tax treaties, mitigate this issue by allocating taxing rights between countries, reducing or eliminating withholding taxes on cross-border dividends, interest, and royalties, providing mechanisms for resolving disputes through mutual agreement procedures, MAP. Understanding treaty networks is a cornerstone of international tax planning. For example, routing royalties through a country with a favorable treaty network can significantly reduce withholding tax leakage. Transfer pricing, pricing within the group. Transfer pricing refers to the pricing of goods, services, or intangibles transferred between related entities within a multinational group. Tax authorities require that these transactions be priced at arm's length, as if they occurred between unrelated parties. Methods of transfer pricing. The OECD Transfer Pricing Guidelines provide several acceptable methods. Comparable Uncontrolled Price, CUP. Resale Price Method. Cost-Plus Method. Transactional Net Margin Method, TNMM. Profit Split Method. Each method has strengths and weaknesses depending on data availability and the nature of the transaction. Transfer pricing documentation must be robust to withstand scrutiny, often including master files, local files, and country-by-country reports. Controversy and adjustments. Transfer pricing is one of the most litigated areas of tax law. Adjustments can result in double taxation if the counterparty jurisdiction does not provide a corresponding adjustment. Advanced practitioners often engage in advanced pricing agreements, APAs, with tax authorities to gain certainty. Withholding taxes. Withholding taxes are a key mechanism by which source countries collect tax on outbound payments. Typical rates vary widely. Dividends, 0 to 30%. Interest, 0 to 30%. Royalties, 0 to 30%. Treaty relief can significantly reduce these rates, sometimes to zero. Structuring cross-border flows to benefit from reduced withholding is a major planning lever. Permanent establishment (PE) risk. One of the most critical issues in international tax is determining whether a foreign company has a permanent establishment in a jurisdiction, triggering corporate income tax obligations there. Traditional PE definitions focus on physical presence, but BEPS Action 7 and new Nexus rules are expanding the concept to cover significant digital presence. Example: a software company that actively markets to customers in a country and derives substantial revenue might be deemed to have a PE even without a local office, depending on local law and treaty provisions. Controlled Foreign Corporation (CFC) rules. To prevent deferral of tax through offshore subsidiaries, many countries impose CFC rules that require immediate inclusion of certain categories of passive or tainted income earned by foreign subsidiaries. Understanding CFC thresholds, exemptions, and calculation methodologies is crucial to avoid unexpected inclusions. Global Minimum Tax, Pillar 2. A seismic shift is underway with the OECD's Pillar 2 rules, which aim to impose a 15% global minimum tax on the profits of large MNEs. This regime introduces complex concepts such as globe income, top-up taxes, and qualified domestic minimum top-up taxes, QDMTT. Tax teams must model these rules to understand where additional tax may be due and evaluate whether restructuring supply chains, IP locations, or financing arrangements can mitigate exposure. Common planning structures. International tax planners often employ holding companies to consolidate ownership and optimize treaty access, finance companies to centralize intercompany lending and manage withholding, IP companies to house intangible assets in favorable jurisdictions. Each structure must be evaluated for substance requirements, anti-hybrid rules, and potential challenges under principal purpose tests, PPT, and general anti-avoidance rules, GAR. Substance and anti-avoidance. Tax authorities increasingly demand that cross-border structures have genuine commercial substance. Mere letterbox companies without employees, premises, or decision-making power are likely to be challenged. Practitioners must ensure that governance, documentation, and business activity align with the stated purpose of the entity. Ethical considerations and reputation. Public opinion on international tax planning is evolving. While legal minimization of tax remains a fiduciary duty to shareholders, overly aggressive schemes can lead to reputational damage. Many MNEs now adopt tax principles or tax transparency reports to demonstrate responsible behavior. Looking ahead. International taxation is one of the fastest changing areas of the field. Pillar 1's reallocation of taxing rights for digital economy businesses, growing adoption of digital services taxes, and enhanced information sharing among tax authorities will continue to reshape the landscape. Key takeaway: cross-border tax planning is a balancing act that requires mastery of treaties, transfer pricing, PE analysis, and emerging global minimum tax rules. Successful practitioners integrate legal compliance, economic substance, and reputational considerations to create tax strategies that are both effective and defensible. Chapter 4: Transfer Pricing in Depth. Why transfer pricing matters. Transfer pricing is one of the most critical and contentious areas in international taxation. Because intragroup transactions often represent the majority of a multinational enterprise's MNE's value chain, even small adjustments can have massive tax implications. Tax authorities view transfer pricing as a key mechanism to prevent base erosion and profit shifting, while businesses see it as a tool for aligning tax outcomes with economic substance. The arm's length principle. At the heart of transfer pricing lies the arm's length principle, ALP, Related party transactions must be priced as if they occurred between independent enterprises under comparable circumstances. This principle is enshrined in Article 9 of the OECD Model Tax Convention and in most domestic transfer pricing legislation. Challenges of applying ALP. Lack of comparable data. True comparables may not exist, particularly for unique intangibles. Complex value chains. Modern businesses integrate functions across multiple jurisdictions, making it difficult to isolate where value is created. Different market conditions. Price differences across countries complicate comparability. Transfer pricing methods in detail. 1. Comparable uncontrolled price, CUP method. The CUP method compares the price charged in a controlled transaction to the price charged in a comparable uncontrolled transaction. It is considered the most direct and reliable method when data is available. Use case: commodity trading, royalty rates for widely licensed intellectual property. 2. Resale price method, RPM. RPM starts with the resale price to an independent customer and subtracts an appropriate gross margin. The remainder is considered the arm's length transfer price. Use case: distribution entities with limited risk and routine functions. 3. Cost plus method. This method adds an appropriate markup to the costs incurred by the supplier of goods or services. It is common for contract manufacturing and contract R&D arrangements. 4. Transactional net margin method, TNMM. TNMM examines the net profit margin relative to an appropriate base, cost, sales, assets that a taxpayer realizes from a controlled transaction and compares it to margins earned in comparable uncontrolled transactions. Use case: when no reliable gross margin data is available. 5. Profit split method. Profit split allocates the combined profits or losses from related party transactions in proportion to each party's contribution of value-driving functions, assets, and risks. Use case: highly integrated global operations, unique intangibles where one-sided methods are insufficient. Documentation requirements. Most jurisdictions require taxpayers to prepare and maintain detailed transfer pricing documentation, typically consisting of master file, overview of the M&E Group, its global business operations, and transfer pricing policies. Local file, detailed analysis of material transactions affecting the local entity. Country-by-country report, CBCR, aggregate data on revenue, profits, taxes, and employees by jurisdiction. Failure to produce documentation can result in penalties, reversal of burden of proof, or adjustments based on adverse assumptions. Functional analysis. A cornerstone of transfer pricing is functional analysis, mapping out functions performed, manufacturing, R&D, distribution, marketing. Assets employed, tangible assets, intellectual property, financial capital. Risks assumed, market risk, credit risk, product liability risk. This analysis determines the appropriate reward for each entity in the value chain. Intangibles and hard-to-value assets. Intangibles often drive the majority of value in modern businesses, but are notoriously difficult to price. Special guidance exists for hard-to-value intangibles, HTVI, where reliable projections are difficult. DEMPE functions, development, enhancement, maintenance, protection, and exploitation of intangibles. Entities performing DEMPE functions must be appropriately compensated. Advanced pricing agreements, APAs. APAs provide certainty by agreeing in advance with tax authorities on the transfer pricing methodology for specified transactions. APAs can be unilateral, between taxpayer and one tax authority. Bilateral or multilateral, involving multiple jurisdictions to eliminate double taxation risk. APAs require significant effort, but can dramatically reduce controversy. Transfer pricing audits and controversy. Transfer pricing is the #1 cause of international tax disputes. Audits typically focus on High-value transactions, royalties, management fees. Low-taxed entities with significant profits. Changes in business models, e.g., converting distributors to commission agents. Litigation can be lengthy and expensive. Mutual agreement procedures, MAP, and arbitration mechanisms are available under treaties to resolve disputes. Practical case example. Scenario: a global pharmaceutical company develops a new drug in its U.S. R&D center, but licenses the IP to an Irish affiliate. The Irish entity books substantial profits from global sales. Tax authorities challenge whether the Irish affiliate truly performs DEMPE functions and seek to reallocate profits to the U.S. entity. Analysis: practitioners must examine R&D contracts, personnel, decision-making authority, and funding arrangements. A profit split method may be more appropriate than a one-sided cost-plus approach. Technology and transfer pricing. Data analytics and benchmarking tools are transforming transfer pricing. Tax teams increasingly rely on databases of comparable company financials, AI-powered margin analysis, scenario modeling to anticipate tax authority challenges. Strategic considerations. Transfer pricing is not merely a compliance exercise, it is a lever for value creation. Aligning tax outcomes with business substance. Reducing effective tax rates by optimizing value chain design. Minimizing audit exposure by proactively addressing high-risk transactions. Looking ahead. With Pillar 1 potentially reallocating profits of the largest and most profitable MNEs to market jurisdictions, transfer pricing is at an inflection point. Future planning will need to consider new nexus rules, formulary apportionment trends, and increased transparency. Key takeaway: mastery of transfer pricing involves more than applying formulas. It requires deep understanding of the business, robust functional analysis, and strategic alignment with global tax policy trends. Proactive documentation and thoughtful structuring are essential to managing risk and maintaining tax efficiency. Chapter 5: Mergers, Acquisitions, and Tax Structuring. The tax dimension of M&A. Mergers and acquisitions, M&A, are transformative events for businesses, and taxation often plays a pivotal role in structuring these transactions. The tax implications can influence deal valuation, financing decisions, and post-transaction integration strategies. Advanced tax professionals are central to ensuring that the transaction is not only legally compliant, but also tax efficient. Types of acquisitions. Stock purchase. In a stock purchase, the buyer acquires the target company's equity. The tax implications include: step-up in basis is generally limited. Assets retain historical book and tax values. Liabilities, including deferred tax liabilities, transfer to the buyer. Potential use of NOLs may be restricted under internal rules or change of ownership limitations. Asset purchase. An asset purchase involves acquiring individual assets and assuming selected liabilities. Benefits and considerations include: step-up in asset basis, which allows for higher depreciation and amortization. Direct allocation of purchase price to specific assets for tax planning. Potential sales tax on tangible assets, depending on jurisdiction. Merger versus acquisition. Mergers can be structured as statutory mergers or consolidation. The tax treatment differs based on whether the transaction qualifies for tax-free reorganization treatment under domestic law. Tax-free reorganizations. Certain M&A structures qualify as tax-free reorganizations, allowing gains and losses to be deferred rather than recognized immediately. Key requirements typically include: continuity of interest. Shareholders of the target must retain a portion of the equity in the acquirer. Continuity of business enterprise. The target's business must continue post-transaction. Plan of reorganization. The transaction must follow a formal plan that meets statutory requirements. Step up in basis and depreciation planning. A step-up in asset basis occurs when the purchase price exceeds the target's book value of assets. This step-up can generate higher depreciation or amortization deductions, reducing future taxable income. Strategic allocation of purchase price to high-value assets, intangible property, equipment, is a common planning tool. Net operating losses, NOLs. Acquisition planning must account for the target's NOLs. Many jurisdictions restrict the use of pre-acquisition losses after a change of ownership to prevent trafficking in losses. Tax professionals model NOL utilization to optimize future tax benefits. Cross-border M&A considerations. International acquisitions introduce additional layers of complexity. Withholding taxes. Payment of dividends, interest, and royalties to foreign shareholders may trigger withholding obligations. CFC rules. Ownership of foreign subsidiaries may trigger inclusion of passive income. Transfer pricing. Post-acquisition integration may require restructuring intercompany agreements. Tax treaty benefits. Structuring the acquisition to benefit from favorable treaties can reduce exposure to double taxation. Financing the transaction. The method of financing, debt versus equity, affects post-transaction tax outcomes. Debt financing. Interest payments may be deductible, lowering taxable income. Thin capitalization rules must be observed. Equity financing. Dividend distributions are typically non-deductible, but reduce risk of anti-avoidance challenges. Structuring considerations. Key structuring considerations for M&A transactions include entity choice for holding and operating subsidiaries, timing and recognition of gains and losses, alignment with business strategy, regulatory compliance, and anti-avoidance rules. Practical case example. Scenario: a U.S.-based technology company acquires a European startup. The acquisition is structured as an asset purchase to step up IP basis and maximize amortization deductions. Financing is a mix of debt and cash. Transfer pricing adjustments are anticipated to align global profit allocation with economic substance. Analysis. Tax teams must evaluate deferred tax assets, NOL utilization, cross-border withholding, and substance requirements for the new entities. Documentation and pre-transaction APAs are used to minimize audit risk. Risk management and compliance. M&A transactions carry inherent tax risks. Advanced practitioners deploy strategies including pre-closing due diligence to identify contingent liabilities, contractual indemnities for unexpected tax exposure, post-closing integration plans that maintain compliance and optimize tax positions, ethical and reputational considerations. While optimizing tax outcomes is a legitimate goal, practitioners must ensure that structures are defensible and transparent. Aggressive tax planning that exploits loopholes without substance can trigger regulatory scrutiny and reputational damage. Looking ahead. M&A tax planning will continue to evolve alongside changes in domestic and international tax regimes, including global minimum taxes, digital economy taxation, and evolving anti-abuse rules. Staying current and integrating tax planning into strategic decision-making is essential for maximizing shareholder value. Key takeaway: tax considerations permeate every stage of an M&A transaction. Advanced tax professionals must navigate complex domestic and international rules, align structures with business objectives, and manage risk to ensure successful tax-efficient outcomes. Chapter 6: Indirect Taxes, VAT, GST, and Excise. Introduction to Indirect Taxes. Indirect taxes differ fundamentally from direct taxes. While direct taxes are imposed on income or profits, indirect taxes are levied on the consumption of goods and services. Common forms include value-added tax, VAT, goods and services tax, GST, and excise duties. Indirect taxes affect pricing, cash flow, and compliance obligations, making them a critical consideration for multinational businesses. value-added tax, VAT, and goods and services tax, GST. VAT and GST are consumption-based taxes applied at each stage of production and distribution. The end consumer bears the ultimate tax burden, while businesses collect and remit tax on behalf of the government. Key features: input tax credit. Businesses can usually claim credit for tax paid on inputs against tax collected on outputs. Destination principle. Tax is generally levied where the goods or services are consumed. Registration thresholds. Entities must register for VAT GST once sales exceed specified thresholds. Compliance considerations. Invoices and record keeping. Accurate invoicing is essential for claiming input credits and satisfying audit requirements. Cross-border supplies. Exports are typically zero-rated, while imports may attract reverse charge mechanisms. Digital services. Many jurisdictions now require foreign digital service providers to register and collect VAT GST on sales to local consumers. Planning opportunities. Structuring supply chains to optimize input tax recovery. Timing of purchases and sales to manage cash flow impact. Leveraging exemptions and reduced rates where legally permissible. Excise duties. Excise taxes are levied on specific goods such as alcohol, tobacco, fuel, and luxury items. Unlike VAT, excise duties are often included in the price of the product and may be calculated per unit or as a percentage of value. Compliance and strategy. Correct classification and valuation of excisable goods. Monitoring changes in duty rates to avoid underpayment. Supply chain structuring to minimize excise exposure within legal limits. Indirect tax risk management. Indirect taxes often generate disputes due to complex rules, especially with cross-border transactions. Risk management strategies include conducting regular VAT GST health checks and audits, implementing robust invoicing and reporting systems, monitoring local legislative changes and rulings. Case example: cross-border digital services. A multinational software company sells cloud-based subscriptions to customers in multiple countries. VAT GST registration is required in several jurisdictions. Input credits are claimed on local operational expenses, while reverse charge rules apply in certain markets. Proper structuring and automation ensure compliance and minimize cash flow impact. Strategic implications. Indirect taxes influence pricing strategies, supply chain design, and market entry decisions. Businesses must integrate indirect tax considerations into broader commercial and financial planning. Looking ahead. Emerging trends include increased digital reporting and real-time filings, expansion of VAT GST on digital services globally, environmental excise taxes on carbon emissions and single-use plastics. Key takeaway: indirect taxes are ubiquitous in business operations and require strategic planning, robust compliance systems, and continuous monitoring of regulatory changes to avoid risk and optimize financial outcomes. Chapter 7: Tax Risk Management and Controversy. Understanding tax risk. Tax risk refers to the possibility of financial loss, penalties, or reputational damage arising from the interpretation or application of tax laws. In an increasingly complex regulatory environment, managing tax risk is essential for corporate governance and sustainable business operations. Types of tax risk. Compliance risk: failure to comply with filing, payment, or documentation requirements. Interpretation risk: misapplying tax laws, regulations, or treaties. Transaction risk: structuring or executing transactions in a way that triggers unexpected tax exposure. Reputational risk: public or stakeholder backlash from aggressive tax planning, even if legal. Operational risk: errors due to inadequate processes, technology, or human oversight. Tax governance and internal controls. A robust tax governance framework ensures that an organization can identify, assess, and mitigate tax risks. Core components include Tax policy, clear guidelines on risk appetite, planning strategies, and ethical considerations. Roles and responsibilities, defined accountability for tax compliance, reporting, and decision-making. Process controls, standardized procedures for filing, documentation, and approvals. Monitoring and reporting, continuous review of tax positions and escalation of material risks. Audit risk and controversy. Tax authorities increasingly use data analytics and cross-border information sharing to identify high-risk taxpayers. Key areas of scrutiny include transfer pricing and intercompany transactions, R&D tax credits and deductions, cross-border financing arrangements, indirect taxes and compliance gaps. Advanced practitioners anticipate audit exposure through pre-audit reviews and proactive engagement with authorities. Dispute resolution mechanisms. When disputes arise, organizations can rely on multiple mechanisms. Administrative appeals, filing objections or appeals within the tax authority. Mutual agreement procedures, MAP, resolving treaty-based disputes in international taxation. Advanced pricing agreements, APAs, preemptively agreeing on transfer pricing methods. Litigation, pursuing or defending claims in tax courts. Effective dispute management requires timely documentation, clear communication, and strategic decision-making. Tax risk modeling and quantification. Organizations quantify tax risk using probabilistic models, scenario analysis, and sensitivity testing. Key metrics may include potential exposure amounts, likelihood of adverse outcomes, financial statement impact, impact on cash flow and financing, technology in tax risk management. Advanced software solutions help streamline compliance, identify anomalies, and automate reporting. Emerging tools leverage artificial intelligence and machine learning to flag unusual transactions and improve decision-making. Ethical considerations. Balancing tax minimization with compliance and societal expectations is a critical aspect of risk management. Overly aggressive positions can trigger penalties, public scrutiny, and erosion of stakeholder trust. Organizations increasingly adopt tax transparency policies and publicly report tax strategies to demonstrate responsible behavior. Case example, transfer pricing controversy. A multinational consumer goods company undergoes a transfer pricing audit. Authorities challenge the allocation of profits to its low-tax subsidiary. Preemptive documentation, functional analysis, and benchmarking data enable the company to defend its position, negotiate an APA, and avoid double taxation. Best practices. Maintain comprehensive and contemporaneous documentation. Regularly update tax positions to reflect legislative changes. Engage in proactive dialogue with tax authorities where feasible. Integrate tax risk management into overall corporate governance and strategic planning. Looking ahead. As global tax transparency increases and international cooperation among tax authorities strengthens, effective tax risk management becomes more critical. Professionals must remain vigilant, adaptable, and ethically grounded to navigate evolving challenges. Key takeaway: tax risk management is both a defensive and strategic function. It involves identifying exposures, implementing controls, anticipating audits, resolving disputes, and aligning practices with ethical and reputational standards. Chapter 8: Taxation of Emerging Sectors, Digital Economy, Crypto, ESG. Introduction. Rapid technological advancement, evolving business models, and societal priorities have created new sectors requiring specialized tax treatment. The digital economy, cryptocurrency, and ESG-related activities pose unique challenges for tax policy, compliance, and planning. Understanding these emerging areas is essential for advanced tax professionals to remain relevant and effective. Digital economy taxation. The digital economy has disrupted traditional nexus and sourcing rules. Companies providing software, cloud services, or digital platforms often operate globally without physical presence, challenging conventional tax frameworks. Key issues. Significant digital presence. Many jurisdictions are adopting rules that create taxable nexus for digital services, even without physical offices. Digital services taxes, DSTs. Levied on revenue from certain digital activities, DSTs are increasingly common in Europe, Asia, and Latin America. OECD Pillar 1. Reallocation of taxing rights to market jurisdictions, focusing on large multinational enterprises. Planning considerations. Structuring sales and operations to optimize tax exposure. Leveraging tax treaties and exemptions where applicable. Anticipating reporting and compliance obligations in multiple jurisdictions. Cryptocurrency and digital assets. Cryptocurrencies, tokens, and other digital assets present new tax challenges due to their volatility, decentralized nature, and anonymity. Tax treatment. Income recognition. Gains from cryptocurrency trading may be taxable as capital gains or ordinary income depending on jurisdiction. Mining and staking. Rewards from mining or staking may constitute taxable income. Corporate use of digital assets. Corporations accepting crypto for goods or services must determine fair value and report taxable income. Compliance and reporting. Accurate valuation and record keeping are critical. Cross-border transfers may trigger VAT, GST, or withholding tax obligations. Anti-money laundering, AML, and Know Your Customer, KYC regulations intersect with tax compliance. ESG-related taxation. Environmental, social, and governance, ESG initiatives are increasingly influencing tax policy. Governments use fiscal tools to incentivize sustainable behavior and discourage harmful practices. Key mechanisms. Carbon taxes, levied on greenhouse gas emissions to internalize environmental costs. Tax credits and incentives for renewable energy investments, energy-efficient equipment, and sustainable practices. Reporting requirements. ESG-linked tax disclosures may be required for large corporations. Planning opportunities. Structuring investments to maximize available credits. Optimizing supply chain and operations for tax-efficient ESG compliance. Monitoring evolving regulatory frameworks to leverage incentives responsibly. Cross-sector considerations. Emerging sectors often intersect, creating complex tax landscapes. For example, a digital platform may accept cryptocurrency payments and offset carbon credits for ESG compliance. International expansion may trigger cross-border digital taxes, transfer pricing scrutiny, and compliance with new reporting regimes. Practical case example. Scenario: a fintech company offers crypto-based investment products to users globally. The company must account for VAT, GST on digital services in multiple jurisdictions. Income recognition for crypto transactions. ESG incentives for environmentally sustainable investment products. Analysis. Tax planning requires an integrated approach, coordinating direct, indirect, and emerging sector taxes while ensuring robust compliance, documentation, and risk management. Technology in emerging sector taxation. Advanced technology, such as blockchain analytics, AI-driven compliance tools, and real-time reporting software, is increasingly essential for monitoring tax obligations and optimizing positions in these sectors. Ethical and reputational considerations. Emerging sectors are often under heightened regulatory and public scrutiny. Aggressive or non-transparent tax strategies can lead to reputational damage, regulatory penalties, and stakeholder backlash. Advanced tax professionals must balance efficiency with compliance and social responsibility. Looking ahead. Emerging sectors will continue to evolve, driven by innovation, regulatory change, and societal priorities. Tax professionals must stay informed, adaptable, and proactive to navigate complex rules and identify opportunities responsibly. Key takeaway: taxation in emerging sectors requires specialized knowledge, integrated planning, and ethical stewardship. Understanding digital economy, cryptocurrency, and ESG-related taxation equips professionals to advise clients effectively while managing compliance and reputational risk. Chapter 9: Tax Policy, Reform, and Macroeconomic Impacts. Introduction. Tax policy is not only a tool for revenue collection, but also a lever for economic and social objectives. Understanding the interplay between taxation, public finance, and macroeconomic outcomes is essential for advanced tax professionals who advise businesses, policymakers, or investors. Principles of tax policy. Effective tax policy balances several objectives. Revenue adequacy, sufficient funds to finance public goods and services. Equity, fair distribution of tax burdens according to ability to pay. Economic efficiency, minimizing distortions and promoting productive investment. Simplicity and transparency, ensuring compliance is manageable and the rules are understandable. Competitiveness, maintaining attractiveness for investment in a global context. Tax reform mechanisms. Tax reform can take many forms. Rate adjustments, changing personal, corporate, or consumption tax rates. Base broadening or narrowing, expanding or reducing taxable income and allowable deductions. Introduction of new taxes, such as carbon taxes, digital services taxes, or wealth taxes. Anti-avoidance measures, closing loopholes, tightening transfer pricing rules, or introducing global minimum tax policies. Case example: corporate tax rate reforms. A country lowers its statutory corporate tax rate from 30% to 20% while broadening the tax base. While headline rates fall, businesses must carefully recalculate effective tax rates due to reduced deductions and credits, highlighting the importance of integrated planning. Behavioral impacts of taxation. Taxes influence economic behavior. Consumption taxes can reduce demand for tax goods, such as sin taxes on tobacco or alcohol. Corporate taxes affect investment, capital allocation, and financing decisions. Personal taxes influence labor supply, savings, and entrepreneurial activity. Understanding these behavioral effects allows tax professionals to advise on both compliance and strategic business decisions. International coordination. Globalization has increased the need for coordination. BEPS and OECD initiatives prevent base erosion and profit shifting. Global Minimum Tax, Pillar 2, seeks to limit aggressive tax planning by multinational enterprises. Information exchange. Automatic sharing of tax data among countries enhances compliance and transparency. Macroeconomic considerations. Tax policy impacts economic growth, inflation, and income distribution. For example, high marginal tax rates may discourage investment or labor participation. Consumption taxes can stabilize revenue without directly affecting savings and investment decisions. Incentives for green energy investment can stimulate sustainable economic growth. Advanced tax professionals must understand these dynamics to anticipate policy changes and advise clients on potential economic and fiscal impacts. Policy analysis tools. Economists and tax advisors use a range of tools to evaluate tax reforms. Computable General Equilibrium (CGE) models simulate economic effects of tax changes. Dynamic scoring assesses revenue effects, accounting for behavioral responses. Distributional analysis evaluates equity impacts across income groups. Practical considerations for businesses. Businesses must stay abreast of policy changes that could affect effective tax rates, compliance costs, and strategic planning. Scenario planning for potential reforms. Evaluating impacts on cash flow and investment decisions. Engaging in stakeholder dialogue and policy advocacy where appropriate. Ethical and strategic implications. Tax policy and reform shape both the opportunities and constraints for tax planning. Professionals must navigate these changes ethically, ensuring compliance while optimizing positions within legal frameworks. Looking ahead. As economies evolve, tax policy will continue to respond to digitalization, environmental challenges, income inequality, and global competition. Tax advisors must combine technical knowledge with macroeconomic awareness to provide effective guidance. Key takeaway: tax policy and reform influence every aspect of the business environment. Understanding macroeconomic impacts, behavioral responses, and international coordination is crucial for strategic tax planning and policy analysis. Chapter 10: Tax Technology and Automation. Introduction. The rapid advancement of technology is transforming tax practice from compliance to planning. Automation, data analytics, artificial intelligence, and blockchain are increasingly integral tools, enabling professionals to handle complex transactions, reduce errors, and improve efficiency. Key technology trends. 1. Automation and workflow management. Automation streamlines routine tasks such as filing tax returns, data entry and reconciliation, computation of tax liabilities. Workflow management systems ensure timely review, approval, and submission of tax filings, reducing human error and enhancing compliance. 2. Data analytics. Advanced analytics enable tax teams to identify anomalies or risks in large datasets, benchmark transfer pricing, and evaluate comparable transactions, predict audit risk and quantify exposures. Analytics-driven insights support strategic decision-making and proactive risk management. 3. Artificial intelligence, AI, and machine learning. AI applications include natural language processing to interpret legislation and guidance, predictive modeling of tax outcomes, automated detection of compliance gaps and potential fraud. Machine learning algorithms improve over time, enhancing accuracy and decision-making efficiency. 4. Blockchain and distributed ledger technology. Blockchain can facilitate real-time tax reporting, secure, verifiable transaction records, enhanced transparency and auditability. Cryptocurrency transactions, smart contracts, and tokenized assets increasingly rely on blockchain, requiring tax professionals to understand the technology and its implications. Digital platforms and cloud solutions. Cloud-based tax software enables integration across multiple jurisdictions, centralized data management and reporting, collaboration among global tax teams. These platforms reduce operational risk and support compliance with international standards. Robotics Process Automation (RPA). RPA handles repetitive processes such as extracting data from invoices, updating tax ledgers, preparing recurring filings. RPA frees tax professionals to focus on analytical and strategic tasks, enhancing efficiency and accuracy. Cybersecurity and data privacy. With increased reliance on technology, safeguarding sensitive tax and financial data is critical. Key considerations include compliance with data protection regulations, e.g. GDPR, secure storage and transfer of tax records, access control and audit trails for sensitive information, technology-driven risk management. Technology tools aid in monitoring compliance, identifying potential exposures, and supporting documentation for audits. Examples include automated generation of transfer pricing reports, real-time monitoring of VAT GST obligations, predictive alerts for deadlines or regulatory changes, integration with strategic planning. Advanced tax technology supports strategic objectives by modeling tax implications of M&A, cross-border transactions, and emerging sector activities, forecasting effective tax rates and cash flow impacts, evaluating scenarios for digital economy and ESG-related taxes, future trends, increasing adoption of AI-driven advisory tools, enhanced real-time reporting by tax authorities, integration of tax compliance with enterprise resource planning, ERP systems, greater use of blockchain for audit transparency and cross-border reporting. Case example: a multinational corporation uses AI and RPA to manage global VAT GST compliance. Automated extraction of invoice data, classification of goods and services, and real-time reporting minimize errors and improve efficiency. Predictive analytics identify high-risk transactions, allowing proactive correction before audits. Key takeaways: technology is central to modern tax practice, transforming compliance, planning, and risk management. Automation, analytics, AI, and blockchain enhance efficiency, accuracy, and transparency. Tax professionals must stay current with technology trends and integrate them strategically into practice. Chapter 11: Advanced Tax Planning Strategies. Introduction. Advanced tax planning strategies enable businesses and individuals to minimize tax liability, optimize cash flow, and align financial outcomes with strategic goals. These strategies go beyond routine compliance and require a deep understanding of tax law, international principles, and emerging trends. Core principles of tax planning. Effective tax planning is guided by several principles. Legality, compliance with statutes, regulations, and treaty provisions. Economic substance, transactions should reflect genuine business purposes. Timing, leveraging timing of income recognition, deductions, and credits. Integration, coordinating planning across jurisdictions, entities, and tax types. Documentation, maintaining robust records to support positions and defend against audits. Techniques for corporate tax planning. 1. Entity structuring. Optimizing corporate structure can reduce tax exposure. Holding companies centralize ownership and facilitate repatriation of profits. Finance companies optimize intercompany lending and interest deductions. IP companies house intellectual property in favorable jurisdictions. 2. Debt versus equity financing. Interest on debt is typically deductible, reducing taxable income. Advanced planners balance debt and equity to optimize effective tax rates while complying with thin capitalization rules. 3. Transfer pricing optimization. Aligning transfer pricing policies with business functions, risks, and assets ensures compliance and minimizes audit risk, while potentially reducing global effective tax rates. 4. Utilization of losses and credits. Net operating losses, NOLs, strategic use of carry-forwards and carrybacks. Tax credits, leveraging R&D, investment, and ESG-related incentives. 5. Timing strategies. Accelerating deductions and deferring income can optimize cash flow and reduce current year tax liabilities. Monitoring legislative changes to take advantage of temporary incentives or rate adjustments. International tax planning. Treaty planning, structuring transactions to benefit from reduced withholding taxes or treaty exemptions. CFC and BEPS compliance, managing inclusion rules and avoiding base erosion penalties. Global minimum tax considerations, planning for top-up taxes under OECD Pillar 2 rules. Tax-efficient M&A strategies. Integrating tax planning into mergers and acquisitions includes choosing between stock and asset purchases, step up in basis allocation, post-acquisition transfer pricing and integration planning, indirect tax planning, optimizing VAT, GST recovery through supply chain structuring. Timing of cross-border transactions to manage cash flow impacts. Leveraging exemptions and reduced rates legally available. Emerging sector planning. Structuring digital economy operations to comply with DSTs and digital service tax rules. Managing crypto transactions for tax-efficient recognition. Incorporating ESG incentives and credits into financial planning. Risk management and documentation. Every strategy must be supported by comprehensive documentation to withstand audit scrutiny. Techniques include pre-transaction analysis and memos, functional and economic analysis for transfer pricing, scenario modeling for complex structures, ethical considerations. Advanced tax planning must respect ethical boundaries, avoiding abusive or artificial arrangements, balancing shareholder interests with societal expectations, transparency in reporting and disclosures. Practical case example. Scenario: a multinational technology firm centralizes its IP in a low-tax jurisdiction, finances subsidiaries with optimized debt structures, and applies transfer pricing consistent with economic substance. R&D credits and ESG-related incentives are maximized, while global minimum tax exposure is modeled and mitigated. Analysis. By integrating corporate, international, indirect, and emerging sector planning, the company reduces effective tax rates, ensures compliance, and maintains defensible positions across jurisdictions. Looking ahead. As tax regulations evolve, advanced planning strategies will require continuous adaptation, including leveraging technology, monitoring legislative trends, and integrating ethical considerations into strategic decision-making. Key takeaway: advanced tax planning is a holistic discipline, combining technical knowledge, strategic foresight, and ethical judgment to optimize outcomes while managing risk and compliance. Chapter 12: Estate, Gift, and Wealth Tax Planning. Introduction. Estate, gift, and wealth taxation are critical considerations for high net worth individuals and family-owned businesses. Effective planning ensures the transfer of assets across generations while minimizing tax liabilities and preserving wealth. Estate tax planning. Estate tax applies to the transfer of assets upon death. Key considerations include exemptions and thresholds, understanding lifetime exemptions, unified credits, and applicable rates. Gifting strategies, utilizing annual exclusion gifts to reduce taxable estate. Trusts, establishing revocable and irrevocable trusts to manage asset distribution and tax exposure. Valuation, accurate valuation of assets, including real estate, business interests, and investments, is critical. Techniques. Irrevocable life insurance trusts, ILITs, remove insurance proceeds from the taxable estate. Grantor retained annuity trusts, GRATs, transfer appreciating assets to beneficiaries with minimized gift tax. Charitable remainder trusts, CRTs, reduce estate and income taxes while supporting philanthropic goals. Gift tax planning. Gift taxes apply to transfers made during a lifetime. Planning strategies include annual exclusion gifts, leveraging the maximum non-taxable annual gift amount. Lifetime exemption planning, coordinating gifts with estate planning to minimize overall taxation. Valuation discounts, applying minority interest or lack of marketability discounts for business or investment assets. Wealth and net worth tax considerations. Some jurisdictions impose annual wealth taxes based on net asset value. Planning strategies include asset structuring, holding assets in exempt vehicles or jurisdictions. Valuation optimization, regularly reviewing appraisals and valuations to ensure accuracy and potential reductions. Debt management, leveraging deductible liabilities to offset net wealth calculation. Family business succession planning. Gifting ownership interests, gradual transfer of shares to the next generation. Buy-sell agreements, ensuring liquidity and continuity for business transfers. Trusts and holding companies, centralizing family assets and aligning governance with tax planning. Cross-border estate and gift planning. Residency and domicile rules, determining tax obligations based on jurisdictional definitions. Tax treaties, utilizing treaty provisions to avoid double taxation. Foreign asset reporting, ensuring compliance with reporting requirements for offshore holdings. Practical case example. Scenario: a family-owned business plans to transfer ownership to the next generation. Trusts are used to minimize estate tax, while annual gifts reduce the taxable estate. Valuation discounts are applied to minority shares, and cross-border holdings are structured to optimize tax treatment. Analysis: strategic coordination of estate, gift, and wealth tax planning enables asset preservation, compliance, and effective succession while minimizing overall tax liability. Ethical considerations. Planning should respect legal boundaries and societal expectations. Aggressive schemes to avoid tax can lead to reputational damage, legal challenges, and loss of public trust. Looking ahead. Estate, gift, and wealth taxation will continue to evolve with demographic changes, international mobility, and regulatory adjustments. Professionals must integrate planning with family governance, compliance, and ethical stewardship. Key takeaway: effective estate, gift, and wealth tax planning combines legal strategies, valuation expertise, cross-border awareness, and ethical considerations to preserve assets and optimize transfers. Chapter 13: Taxation in Financial Instruments and Investment Planning. Introduction. Investment planning and the taxation of financial instruments are critical components of advanced tax strategy. Knowledge of tax treatment across asset classes allows investors and financial professionals to optimize returns, manage risk, and ensure compliance. Taxation of capital gains and losses. Capital gains, taxed when assets are sold at a profit. Rates may vary by holding period, short-term versus long-term. Capital losses can offset gains to reduce taxable income, subject to limitations. Carry forward and carry back. Losses may be carried forward or back to offset taxable gains in other periods. Planning techniques. Timing of asset sales to minimize tax impact. Loss harvesting to offset realized gains. Asset location strategies across taxable and tax-advantaged accounts. Dividends and interest income. Dividends may be qualified or non-qualified with varying tax rates. Interest, generally taxed at ordinary income rates, though some government or municipal bonds may be exempt. Planning opportunities. Investing in tax-advantaged instruments, e.g. municipal bonds. Timing distributions for income deferral or tax rate optimization. Derivatives and complex instruments. Options. Tax treatment depends on whether exercised, expired, or sold. Futures and forwards may be taxed under mark-to-market rules. Swaps. Income may be treated as ordinary capital or according to specific rules. Strategic considerations. Assessing the timing and recognition of gains and losses. Leveraging derivatives for hedging tax exposure. Understanding jurisdiction-specific rules for complex instruments. Retirement and tax-advantaged accounts. Individual retirement accounts, IRAs, 401ks, and pension plans. Contributions may be tax-deductible, with growth deferred until withdrawal. Roth accounts, contributions are post-tax but distributions are tax-free. Planning, balancing tax deferral, liquidity needs, and long-term growth objectives. Cross-border investment taxation. Withholding taxes on dividends, interest, and royalties from foreign investments. Tax treaties can reduce withholding rates and prevent double taxation. Reporting requirements, compliance with FATCA, CRS, and other disclosure rules. Tax-efficient portfolio construction. Diversification across tax treatments, balancing taxable, tax-deferred, and tax-exempt assets. Asset location, placing income-generating assets in tax-advantaged accounts. Timing strategies, deferring gains or accelerating losses in response to market conditions. Risk management and compliance. Proper record-keeping and valuation for investment portfolios. Monitoring legislative changes affecting taxation of instruments. Coordinating with advisors for holistic compliance across jurisdictions. Practical case example. Scenario: an investor holds U.S. equities, foreign bonds, and cryptocurrency. Tax planning involves utilizing long-term capital gains rates for equity sales, claiming foreign tax credits on overseas income, structuring crypto transactions to manage recognition of gains and losses. Analysis: integrated planning across asset classes and jurisdictions minimizes effective tax rates while ensuring compliance. Ethical considerations. Investment tax planning should comply with both letter and spirit of law, avoiding abusive structures or concealment of taxable income. Transparency, documentation, and responsible advisory practices are essential. Looking ahead. The taxation of financial instruments will continue to evolve with digital assets, fintech innovations, and international coordination. Professionals must remain informed to optimize investment outcomes, manage risk, and maintain compliance. Key takeaway: advanced understanding of financial instrument taxation allows for strategic investment planning, balancing returns, compliance, and ethical considerations across domestic and international landscapes. Chapter 14: Corporate Restructuring and Tax Optimization. Introduction. Corporate restructuring is a strategic tool for enhancing operational efficiency, achieving financial goals, and optimizing tax positions. Tax considerations are central to restructuring decisions, influencing the structure, timing, and implementation of mergers, spin-offs, divestitures, and reorganizations. Types of corporate restructuring. 1. Mergers and acquisitions, M&A. Stock versus asset purchase determines the step-up in basis and treatment of liabilities. Tax-free reorganizations, qualifying mergers can defer recognition of gains or losses. Cross-border considerations, alignment with treaties, withholding taxes, and CFC rules. 2. Spin-offs and divestitures. Spin-offs, distribution of subsidiary stock to parent company shareholders, often structured for tax deferral. Divestitures, sale of business units or assets, requiring careful consideration of capital gains and depreciation recapture. 3. Debt and equity restructuring. Refinancing debt to optimize interest deductions. Equity infusion to reduce leverage and improve credit metrics. Compliance with thin capitalization and anti-abuse rules. 4. Reorganizations and consolidations. Reconfiguring entity structures to align with operational goals and tax efficiency. Utilization of losses and credits within consolidated groups. Integration of international subsidiaries for transfer pricing optimization. Tax optimization strategies. Step up in basis. Acquiring assets at fair market value allows higher depreciation or amortization deductions. Strategic allocation of purchase price among assets to maximize tax benefits. Loss utilization. Consolidating losses across entities or jurisdictions. Carry-forwards and carrybacks to offset taxable income. Planning for limitations due to change of ownership rules. Transfer pricing and profit allocation. Reconfiguring intercompany agreements to reflect economic substance. Aligning profits with value-creating functions. Ensuring documentation supports methodology to withstand audit scrutiny. International tax considerations. Managing CFC rules, withholding taxes, and treaty benefits. Planning for global minimum tax implications, OECD Pillar 2. Structuring IP, financing, and operations to optimize cross-border tax outcomes. Risk management and compliance. Ensuring transactions comply with domestic and international laws. Maintaining documentation for regulatory review. pre-transaction tax analysis, and simulations to anticipate exposures. Practical case example. Scenario: a multinational company restructures by merging two subsidiaries, spinning off a non-core business, and refinancing debt. Tax planning involves step up in asset basis for the merged entity, utilizing accumulated NOLs in the divested unit, aligning transfer pricing policies post-restructuring to reflect functional changes, analysis, integrated planning across corporate, international, and intercompany considerations maximizes tax efficiency while maintaining compliance and operational alignment. Ethical considerations. Avoiding abusive transactions designed solely for tax avoidance. Ensuring transparency with stakeholders and regulatory authorities. Maintaining alignment with the company's ethical and governance standards. Looking ahead. Corporate restructuring will continue to evolve with globalization, regulatory changes, and emerging business models. Tax professionals must integrate legal, financial, and operational perspectives to optimize outcomes. Key takeaway: successful corporate restructuring requires strategic tax planning, risk management, and ethical consideration, leveraging all available tools to achieve operational efficiency and tax optimization. Chapter 15: International Tax Compliance and Reporting. Introduction. Global business operations create complex international tax obligations. Compliance and reporting are critical to avoid penalties, maintain reputational integrity, and optimize global tax positions. Advanced tax professionals must navigate a landscape of treaties, regulations, and reporting requirements across multiple jurisdictions. Core principles of international tax compliance. Substance over form. Transactions should reflect economic reality. Timely and accurate reporting. Filing returns, disclosures, and payment of taxes within prescribed deadlines. Documentation. Maintaining robust records for cross-border transactions, transfer pricing, and other international obligations. Ethical conduct. Adhering to both the letter and spirit of the law. Key reporting requirements. 1. Transfer pricing documentation. Master file provides an overview of global operations and transfer pricing policies. Local file, detailed information on specific related party transactions. Country-by-country report, CBCR, aggregate financial information by jurisdiction for large multinational enterprises. 2. Foreign account reporting. FATCA, Foreign Account Tax Compliance Act. U.S. taxpayers must report foreign financial assets. CRS, Common Reporting Standard, global exchange of financial account information among participating jurisdictions. 3. Controlled Foreign Corporation, CFC rules. CFC rules require inclusion of certain passive income from foreign subsidiaries in the parent company's taxable income. Compliance ensures avoidance of unexpected taxation or penalties. 4. Withholding taxes. Correct application of withholding rates on cross-border payments of dividends, interest, and royalties. Leveraging treaty benefits to reduce withholding where applicable. Compliance challenges. Complex and evolving regulations across jurisdictions. Coordination between local finance teams and global tax functions. Differences in reporting standards and definitions. High volume of transactions requiring systematic tracking. Technology for compliance. Automated reporting tools for transfer pricing, CBCR and FATCA CRS. ERP integration for real-time tracking of cross-border transactions. AI-driven analysis to identify anomalies and potential compliance gaps. Risk management. Pre-filing reviews and audits to ensure accuracy. Scenario modeling to anticipate tax exposure. Maintaining contemporaneous documentation for audit defense. Engaging with tax authorities proactively when uncertainties arise. Practical case example. Scenario: a multinational corporation operates in 15 jurisdictions. Tax compliance involves preparing CBCR for each fiscal year, documenting transfer pricing methods for intercompany transactions, reporting foreign bank accounts, and adhering to withholding tax requirements. Analysis: integrated compliance strategy minimizes risk, ensures regulatory adherence, and supports strategic tax planning. Ethical considerations: avoiding misreporting or aggressive interpretations that violate laws. Transparency with stakeholders and regulators. Maintaining corporate reputation and ethical integrity. Looking ahead. International tax compliance is increasingly scrutinized, with global information exchange and digital reporting trends. Professionals must remain informed about regulatory changes, adopt advanced technology, and integrate ethical judgment into compliance practices. Key takeaway: effective international tax compliance and reporting require thorough knowledge of cross-border rules, robust documentation, strategic use of technology, and adherence to ethical standards to mitigate risk and maintain corporate integrity. Chapter 16: Tax Controversy and Dispute Resolution. Introduction. Tax controversy arises when taxpayers and tax authorities disagree over the application or interpretation of tax laws. Effective management of disputes is essential to protect financial interests, maintain compliance, and preserve reputational integrity. Sources of tax controversy: transfer pricing adjustments, disagreements over arm's-length pricing. Cross-border transactions, conflicts related to withholding taxes, CFC rules, or treaty interpretations. Indirect taxes, VAT, GST audits, refunds, or compliance disputes. R&D credits and incentives, differing interpretations of qualifying activities. Corporate restructuring, disputes over mergers, acquisitions, or reorganizations. Dispute resolution mechanisms. 1. Administrative appeals. Filing objections within the tax authority. Negotiation and settlement of contested positions. Reduces time and cost compared to litigation. 2. Mutual Agreement Procedure, MAP. Resolves treaty-related disputes between two countries. Prevents double taxation for cross-border transactions. Requires timely initiation and detailed documentation. 3. Advanced Pricing Agreements, APAs. Pre-negotiated agreements on transfer pricing methods. Can be unilateral, bilateral, or multilateral. Provides certainty and reduces audit exposure. 4. Litigation. Tax court or tribunal proceedings. Often the last resort due to cost, complexity, and duration. Requires comprehensive evidence and expert testimony. 5. Alternative Dispute Resolution, ADR. Mediation and arbitration offer flexible solutions. Encourages settlement while maintaining professional relationships. Risk management in tax controversy. Documentation. Maintain contemporaneous records of transactions and positions. Early assessment. Identify high-risk areas and potential exposures. Strategic engagement. Determine when negotiation, MAP, or litigation is optimal. Communication. Clear and transparent dialogue with tax authorities. Technology in dispute management. Automated tracking of audits, deadlines, and correspondence. Data analytics to evaluate risk and support positions. Secure document management to facilitate evidence preparation. Practical case example. Scenario: a multinational company faces a transfer pricing audit across multiple jurisdictions. Discrepancies in royalty allocations trigger adjustments. Resolution approach. Initiate MAP to resolve double taxation issues. Provide detailed functional and economic analysis. Negotiate bilateral APAs for future transactions. Document all positions to support audit defense. Outcome: the company mitigates financial exposure, maintains compliance, and establishes a defensible position for future tax planning. Ethical considerations: avoiding misrepresentation or concealment of information. Transparent disclosure of risks and positions to clients and authorities. Balancing aggressive defense with compliance and corporate responsibility. Looking ahead. Tax controversies will evolve with increased global coordination, digitalization, and regulatory scrutiny. Advanced professionals must anticipate disputes, employ technology, and integrate strategic, ethical, and practical considerations in resolution processes. Key takeaway: effective tax controversy management requires proactive risk assessment, strategic dispute resolution, robust documentation, and ethical conduct to protect financial and reputational interests. Chapter 17: Tax Policy and Economic Development. Introduction. Tax policy is a critical instrument for promoting economic development. Beyond revenue collection, governments use tax systems to influence investment, consumption, innovation, employment, and income distribution. Advanced tax professionals must understand the interplay between taxation and macroeconomic objectives to provide strategic guidance. Objectives of tax policy in economic development. Revenue mobilization, funding public infrastructure, social programs, and essential services. Investment promotion, incentivizing domestic and foreign investment through tax credits, holidays, and preferential rates. Job creation, encouraging entrepreneurship and business expansion through targeted incentives. Innovation and R&D, promoting technological advancement via R&D credits and grants. Equity and redistribution, using progressive taxes, exemptions, and deductions to reduce income inequality. Types of development-oriented tax measures. 1. Investment incentives. Tax holidays for new businesses. Accelerated depreciation for capital expenditures. Sector-specific incentives for manufacturing, technology, or renewable energy. 2. Consumption-based measures. Reduce VAT GST rates on essential goods. Excise duties on harmful products to influence consumption behavior. 3. Corporate tax reforms. Lower statutory rates to attract multinational investment. Incentives for reinvestment of profits in productive activities. 4. R&D and innovation incentives. Tax credits for research activities. Grants for innovation-focused projects. Intellectual property incentives to encourage patenting and commercialization. Behavioral and economic impacts. Investment response. Tax incentives can alter business location and capital allocation decisions. Consumption patterns. Indirect taxes influence demand for goods and services. Employment effects. Incentives may encourage hiring and workforce development. Innovation outcomes. R&D-focused policies stimulate technological advancement and productivity growth. International considerations. Harmonization of incentives to attract foreign direct investment. Tax treaties to prevent double taxation and encourage cross-border investment. Compliance with OECD BEPS principles to avoid abusive profit shifting. Risk and policy evaluation. Revenue impact, assessing trade-offs between incentives and government revenue. Effectiveness, monitoring whether tax measures achieve intended economic outcomes. Equity, ensuring benefits do not disproportionately favor specific groups or corporations. Practical case example. Scenario: a developing country implements tax holidays for renewable energy companies and offers accelerated depreciation for new manufacturing plants. Analysis. Investment in green technology increases. Employment rises in targeted sectors. Government monitors revenue loss to adjust policy in subsequent years. Tax professionals advise companies on compliance, optimization, and reporting. Ethical and governance considerations. Avoiding favoritism or abuse of incentives. Ensuring transparent reporting and accountability. Aligning tax policy with sustainable development goals and societal welfare. Looking ahead. Tax policy will continue to play a pivotal role in shaping economic development, particularly in the context of globalization, digitalization, and ESG priorities. Policymakers and tax professionals must collaborate to design effective, equitable, and sustainable taxation frameworks. Key takeaway: tax policy is a strategic tool for economic development. Properly designed and implemented measures can stimulate investment, innovation, job creation, and equitable growth while maintaining fiscal sustainability. Chapter 18: Emerging Trends in Global Taxation. Introduction. Global taxation is evolving rapidly due to digitalization, globalization, environmental concerns, and social expectations. Advanced tax professionals must stay informed about emerging trends to anticipate challenges, advise clients effectively, and optimize compliance and planning strategies. Digitalization and the digital economy. Digital services taxes, DSTs. Countries are implementing DSTs targeting revenue from digital activities, particularly by multinational tech companies. OECD Pillar 1 and Pillar 2. Reallocation of taxing rights and introduction of a global minimum tax framework. Automation and real-time reporting. Tax authorities increasingly require electronic filing, e-invoicing, and real-time transaction reporting. Environmental and ESG taxation. Carbon taxes, levied to internalize environmental costs. Green incentives, tax credits and deductions for renewable energy, energy efficiency, and sustainable practices. ESG reporting requirements, growing expectations for disclosure of tax and sustainability practices. Cross-border tax cooperation. Information exchange, automatic exchange of financial account information under CRS and FATCA. Anti-BEPS measures. Countries adopting OECD recommendations to prevent base erosion and profit shifting. Global tax transparency, public disclosure initiatives, including country-by-country reporting. Cryptocurrencies and digital assets. Regulatory frameworks for taxation of cryptocurrencies, tokens, and NFTs are evolving. Tax authorities are focusing on reporting, valuation, and treatment of digital assets. Professionals must integrate crypto taxation with broader financial planning and compliance. Technology in tax compliance and planning. AI, machine learning, and analytics are transforming risk assessment, transfer pricing, and audit defense. Robotic process automation, RPA, reduces manual errors and improves efficiency. Blockchain offers potential for secure, transparent, and auditable tax records. International and local regulatory developments. Rapidly changing rules in developing economies and digital markets. Shifts in corporate tax rates and incentive structures to attract investment. Alignment with international treaties and global minimum tax standards. Strategic implications for businesses. Proactive planning, monitoring trends to anticipate tax obligations and opportunities. Integrated compliance, aligning direct, indirect, and emerging sector taxation. Risk management, identifying and mitigating potential exposures from new regulations. Ethical considerations, balancing optimization with transparency and societal expectations. Practical case example. Scenario: a multinational digital platform faces DSTs in multiple jurisdictions, new reporting requirements for digital services, and crypto-based transactions. Analysis: implement AI-driven compliance systems to track obligations. Leverage treaties and exemptions to reduce withholding taxes. Integrate ESG and sustainability incentives into overall tax planning. Maintain robust documentation to support positions and manage audits. Looking ahead. Emerging trends indicate a future of increased transparency, digital compliance, ESG-linked taxation, and global coordination. Tax professionals must continuously adapt strategies, embrace technology, and maintain ethical standards. Key takeaway: staying ahead of emerging global tax trends is critical for compliance, planning, and strategic advantage in an increasingly complex and digitalized tax landscape. Chapter 19: Integrating Tax Strategy with Business Strategy. Introduction. Tax strategy is most effective when fully integrated with overall business strategy. Advanced tax planning goes beyond compliance to influence corporate decisions, optimize cash flow, and support sustainable growth. Successful integration aligns financial, operational, and strategic objectives while managing risk and ethical responsibilities. Principles of integration. Alignment with business objectives. Tax planning should support profitability, growth, and long-term sustainability. Holistic approach. Consider direct, indirect, international, and emerging sector taxes together. Risk-aware decision-making. Incorporate tax risk assessment into corporate governance and decision-making processes. Ethical and reputational alignment. Maintain transparency and compliance to protect reputation and stakeholder trust. Tax in strategic business decisions. 1. Investment decisions. Evaluate tax implications of new projects, acquisitions, or capital expenditure. Incorporate incentives, credits, and deductions into financial modeling. Consider jurisdictional tax rates and compliance requirements. 2. Financing and capital structure. Optimize debt-to-equity ratios for tax efficiency. Plan interest deductions, thin capitalization compliance, and financing arrangements. Coordinate with Treasury to manage cash flow and minimize cost of capital. 3. Mergers and acquisitions. Align transaction structure with tax-efficient outcomes. Utilize step-up in basis, loss carry-forwards, and transfer pricing adjustments. Consider post-merger integration and ongoing compliance requirements. 4. Supply chain and operational planning. Structure supply chains for indirect tax efficiency, VAT GST optimization. Centralize or decentralize functions based on tax, operational, and regulatory considerations. Assess cross-border implications of intercompany transactions. 5. Risk management. Implement robust tax governance frameworks. Monitor potential exposures and emerging tax risks. Integrate dispute resolution strategies into corporate planning. Technology and analytics in integration. Use predictive modeling and scenario analysis for decision-making. Employ ERP systems, AI, and data analytics to evaluate tax impact of strategic initiatives. Leverage real-time reporting to support timely and informed decisions. ESG and sustainable business alignment. Incorporate tax incentives for green initiatives, renewable energy, and social impact programs. Align tax strategy with sustainability reporting and ESG objectives. Monitor regulatory trends to capitalize on emerging opportunities. Practical case example. Scenario: a multinational enterprise evaluates the launch of a new product line in multiple jurisdictions. Integration approach. Analyze corporate tax rates, R&D incentives, and indirect taxes. Structure financing to optimize deductions and minimize global effective tax rate. Ensure supply chain efficiency while complying with transfer pricing and cross-border rules. Use predictive analytics to model cash flow, compliance obligations, and potential risks. Outcome: tax strategy is seamlessly aligned with business objectives, supporting profitability, compliance, and sustainable growth. Ethical and governance considerations. Maintain transparency in planning and reporting. Avoid aggressive strategies that compromise integrity or reputation. Integrate ethical judgment into decision-making at all levels. Looking ahead. Future business strategy will increasingly require integrated tax planning as part of digitalization, globalization, and ESG considerations. Tax professionals must collaborate across functions, leverage technology, and align planning with corporate vision. Key takeaway: integrating tax strategy with business strategy ensures that tax considerations enhance, rather than hinder, organizational goals. Holistic, ethical, and proactive planning drives efficiency, compliance, and sustainable value creation. Conclusion. Summary of key insights. This book has explored the multifaceted world of advanced taxation, providing a comprehensive examination of both theoretical and practical aspects. From foundational principles to emerging trends, professionals are equipped to navigate complex tax landscapes across jurisdictions and industries. Core takeaways. Foundational knowledge. Understanding the principles of tax law, compliance, and governance is essential for any advanced practitioner. Corporate and international taxation. Effective planning requires mastery of domestic rules, international frameworks, transfer pricing, and cross-border considerations. Emerging sectors. Digital economy, cryptocurrency, and ESG-linked taxation demand innovative and adaptable strategies. Technology integration. AI, automation, blockchain, and analytics enhance compliance, risk management, and strategic planning. Ethics and professional responsibility. Ethical conduct and transparency underpin sustainable, defensible, and reputable tax practice. Strategic alignment. Tax planning is most effective when integrated with corporate strategy, financial decisions, and long-term business objectives. Dispute resolution and policy awareness. Proactive risk management, dispute resolution mechanisms, and policy monitoring are critical to mitigating exposures. Looking forward. The taxation landscape is evolving rapidly due to globalization, digitalization, regulatory reform, and societal expectations. Advanced tax professionals must remain vigilant, continuously update knowledge, and leverage technology to adapt to changing circumstances. By combining technical expertise with ethical judgment and strategic foresight, practitioners can navigate complexity while delivering value to clients and organizations. Final thoughts. Advanced taxation is more than a compliance function. It is a strategic lever that influences decision-making, business performance, and societal outcomes. Mastery requires continuous learning, practical experience, and a commitment to integrity. Professionals who embrace these principles are well-positioned to shape the future of taxation and contribute to sustainable, responsible economic growth. Closing key message. The integration of knowledge, strategy, ethics, and technology forms the cornerstone of advanced taxation, empowering professionals to manage complexity, optimize outcomes, and uphold trust in the global tax system.